For the final exam review of ACCT 7060 Accounting for Managers, right? Today we are going to go through what I consider to be the most important slides as you prepare for your final exam. So if I bring you back to the first two sessions of the class, right? I introduced to you the accounting equation, right? If you guys remember, the accounting equation would be defined as assets equals to liabilities plus owner's equity. And this accounting equation should always hold in all transactions, right? And as well as on the balance sheet, when we see total assets must always be equal to total liabilities plus shareholders' equity, right? And what is shareholders' equity? This is kind of a abstract concept. So I've broken it down into two parts. The first part would be the capital stock, right? If you recall in the first class, I sort of introduced to you the concept of a lemonade stand, right? So imagine that you want to start a small business on campus to sell lemonade, and so you put in like $50 into the business, and that would form your capital stock, meaning that you own the business, and this $50 goes towards the starting capital stock. Of course, later on in class, we also covered what if firms want to issue more shares to raise more capital, right? Then that would also constitute capital stock, where anybody kind of from the open market can buy these shares and also own part of the business, right? So that is your kind of what we call the shareholders stock or common stock or capital stock. Right. So the other concept that we introduced was also the concept of retained earnings. So these would be the cumulative earnings of the company from the start of its business to the current date, right? Retained earnings appears as a balance on the balance sheet. And so we would have to calculate at each period, what is the ending retained earnings for that period? And how we calculate that would be to start with retained earnings at the beginning of the period, for example, 1st of January, right? Then we would add the net income for that period, meaning from 1st of January to 31st of December, right? And then we would less off any dividends declared and paid for that period. Okay, so this this equation would give us the ending retained earnings as at 31st of December, which would then be reported onto the balance sheet. Okay, and so how do we calculate net income? Over here, net income would be total revenue minus of your total expenses to get the net income for the year. And so revenue minus expenses would be shown in a statement called the income statement. All right, so this slide is just to kind of recap what is the accounting equation, what are the different components making up of the accounting equation. Now, furthermore, right, I introduced the concept of accounts, right? And the purpose of accounts is really to track the increases and decreases in the financial statement items, okay? What are financial statement items? For example, cash, accounts receivable, inventory, accounts payable, so on and so forth, okay? And we use what we call the T account to track these increases and decreases. It is called a T account because of the letter T over here. All right, and there are three elements for each T account. At the top, we would have the account title, okay, for example, cash or accounts receivable. On the left-hand side of the T, we would have the debit side, right? Whatever amounts we want to debit. And on the right-hand side, we would have the credit side, meaning whatever amounts we need to credit to that particular account. How do we remember if it is debit or credit, right? I introduced to you the picture of DC, okay? So DC, D is on the left and C is on the right, meaning that debits always go on the left side and credits always go onto the right side. Okay. Furthermore, I introduced the concept of double entry accounting, where every transaction, right, must be recorded by equal dollar in debits and credits, meaning that when you write a journal entry, the total debits must be equal to the total credits. And this is how we ensure that the overall accounting equation still continues to hold. Right. Besides what we call the regular journal entries, I also introduced to you the concept of adjusting entries. Right. We have to do adjusting entries at the end of each financial period for a variety of reasons. Right. And one kind of important reasons would be what we call supplies. Okay, so supplies are kind of a special item because we do not account for every pencil that we use, right? For example, supplies is made up of a lot of pencil, stationery, kind of individually minute items, right? And so we do not update the accounts every time we use them, but rather we would just take the ending and the starting and figure out how much we used in between. Okay, so in this example, right, at the end of November, we had $1,800 of supplies left over, right? And at the end of December, we realized that a physical count shows only $1,200 left over. Okay, this must mean that during the month of December, $600 of supplies was being used. How did I get $600? It is simply $1,800, the beginning balance, minus $1,200, which is the ending balance, right? That gives me $600. So how do I account for adjusting entries? Okay, so first up, we would have to record the expense. Okay, so if you recall, right, expenses is part of retained earnings, and expenses actually decrease retained earnings, right? So if it decreases retained earnings, it also decreases shareholders' equity. Shareholders' equity is on the right-hand side of the accounting equation because A equals to L plus E, and so on the right-hand side, it increases on the right. Okay, so DC, if I want retained earnings or I want shareholders' equity to decrease, I would actually have to use debit. Right? It increases on the right, it decreases on the left. DC, D is on the left, and therefore I debit supplies expense to show that I've used up $600 worth of supplies. Now, on the credit side, right, we would then have to credit the relevant inventory account, which would be supplies in this case. Okay, supplies is an asset account because we own the stationery, right, and we are entitled to use the stationery for our economic benefits. So supplies is an asset account. Assets is on the left-hand side of the equation and therefore increases on the left. DC increases on the left, meaning I debit to increase, I credit to decrease. To show the decrease in supplies, I would then credit supplies $600. Okay, so this is a classic example of how adjusting entries would be done for recording supplies. Now, the other kind of adjusting entry that we went through in class, right, and also through your various assignments and in-class practices would be the concept of depreciation, right? So once again, depreciation would mean we have a large cost for a particular asset, a long-term asset, right? And we do not want to take it as an expense in the year that we buy it because we are going to use it over a period of time. So what we are going to do is to allocate kind of this large sum of money over the course of its useful life. Right? So for example, if I buy a building and I intend to use it for 20 years, I am going to allocate the total cost of the building over the 20 years so that my expenses do not take a big hit in the year that I use it or in the year that I pay it, but rather across all the years that I'm going to use the building for. Okay, so in this example, right, we purchased a $36,000 building on 22nd of January and it has a useful life of 20 years. So if we consider kind of a straight line depreciation, which is a simple average, right, we are going to have $36,000 divided by 20 years times 12 months in a year, right? That would give us $150 for monthly depreciation for this particular building. And so the adjusting entry just for the month of December would be, first up, debit depreciation expense building $150, right? And second, credit accumulated depreciation building $150. Okay, so just to kind of remind you that for accumulated depreciation, it is a contra asset account, meaning that it's going to reduce the net value of our assets. So on the balance sheet, we would see buildings, right? So buildings, $36,000, this line item doesn't change. The next line we would have on the balance sheet would be less accumulated depreciation building. And for example, if it has only been depreciated for 1 month, less accumulated depreciation building, $150. And finally, the net book value of the building, which is 36,000 minus $150. Okay, so accumulated depreciation is a contra asset account, reducing the net book value of our assets. And very importantly, when you guys write the accounting or adjusting entry, you should always specify the asset for which the accumulated depreciation is for, right? In this case, that would be building. All right, the other kind of adjusting entry that we also discuss in class would be to accrue uncollected revenue, right? Where in many cases we actually perform the services or we deliver the goods, but we have yet to receive the cash and probably only going to receive the cash after year end. Okay, so as at year end, right, we have to record the revenue that we have already earned, even though we have yet to receive the cash. So in this example, right, on 15th of December, we sign a new contract to provide maintenance service for $1,500 a month, and the first monthly payment is going to be due after year end, right, 15th of January 2022. So how do we account for the maintenance service that we have already provided from 15th of December to 31st of December, right? That is 2 weeks worth of maintenance service that we have already provided. So we are going to take $1,500 divided by 2, right? Because that is 2 weeks of maintenance service, right? So it's half a month being provided. And we are going to debit accounts receivable, $750, okay? And credit service revenue, $750. Right? So the key here is that we record the service revenue that has already been provided from 15th of December to 31st of December, right? And to remind ourselves, kind of to collect the cash later on, we have to debit AR to show that there is a receivable after the year end of $750. Okay, so kind of as an extension to this example, right, what is the entry that we're going to do on 15th of January, right, when the kind of the first monthly payment is going to be made? Okay, first we are going to debit cash $1,500 because in the contract it is stated that there is a monthly payment due on 15th of January, so that is for the full amount of $1,500. Okay, second, we are going to credit AR, right? This is to reverse the AR that was first accounted for on 31st of December. Okay, so if I have a debit balance of AR 750, I credit AR to show that the cash has been received, and so AR balance should now be 0. Okay. Furthermore, from the 1st of January to 15th of January, I also provided 2 weeks of maintenance service, and so I should record 2 weeks of service revenue, $750. Okay, so this is kind of an extension to the adjusting entry when we receive the payment later on. All right, so after we have done all of our adjusting entries, right, I also introduced to you the concept of an adjusted trial balance, where the adjusted trial balance must be updated to include the amounts after adjusting entries, right? So for example, right, accounts receivable has been updated as at year end, right? We increased it by $750. So if I were to provide you the trial balance pre-adjustment, okay, you are going to add the $750 to AR account to arrive at the adjusted trial balance post-adjustment. Right, so this 7250 here should include the increase in $750. Similarly, for shop supplies, right, say that the trial balance I provide to you is pre-adjusted, meaning that shop supplies is only going to show $1,800, right? But because we reduce shop supplies by $600, the adjusted trial balance that you're going to prepare should show the updated amount post-adjustment, which is $1,200. Okay, so this is what the adjusted trial balance is. If I provide you a pre-adjusted trial balance, right, and ask you to write adjusting entries, and then I ask you to prepare the adjusted trial balance, you are going to factor in each adjusting entry, which account did it affect, and what is the post-adjustment figure. Okay, so adjusted trial balance would have all the items or all the accounts that the company has. Of course, we would have assets, we would have liabilities, as well as shareholders' equity. Okay, so that is for the adjusted trial balance, right? And after we prepared the financial statements, as we saw in your assignment one, of course, we then went on to talk about inventory and purchases, right? So this is the next topic that I wanted to talk about. For inventory and purchases, right, I introduced to you the concept of a purchase credit and discount, okay? And so let us go through this example together. On 3rd of November, right, the company purchased some spreadsheet programs from PC Products for $10,000, and it has a credit term 2, 10, and 30, and it was paid on 7th of November. Okay, to recap, the credit term 210, meaning if you pay within 10 days of receiving the invoice, you would enjoy a 2% discount, right? Otherwise, if you do not want to pay within 10 days, you have to pay the full amount within 30 days, and therefore it's N30. Okay, recall that in class I told you before you get excited to calculate the 2%, first of all, you should determine whether the discount should be applied, right? And in this case, it was paid on 7th of November, which is just 4 days after 3rd of November. And so in this case, the credit discount actually applies. Okay, so then you can write, in the exam, you can write, remember to include discount, okay, when you write the journal entries. So what are the different entries for purchases? There are two kinds of journal entries. The first would be to record the increase in inventory, right? You purchase spreadsheet programs and that's going to increase your inventory, right? So I'm going to debit inventory, $10,000, credit accounts payable, $10,000. Okay, because on 3rd of November, I have yet to pay up the price for the inventory. And so I'm going to credit AP to remind myself to pay later on. Now, on 7th of November, when I finally paid it off, I'm going to reverse the full amount of AP, which is $10,000. So debit AP, $10,000, right? And recall that I took advantage of the credit term of 2%, and 2% of $10,000 is $200. So I am only paying $9,800 in cash. So credit cash, $9,800. And the remaining discount of $200, I'm going to reduce the value of my inventory by doing credit inventory, $200. Okay, so recall that the definition of inventory would be whatever cost is incurred to prepare it ready for sale, right? And in this case, because we actually had a discount on the inventory, the cost that we pay for the inventory is lowered by $200. And so here we are going to reduce the cost of our inventory in our own internal accounts, and therefore we are going to credit inventory $200. Now, what about transportation costs, right? If you remember this figure, I said that there are two kinds of shipping cost policies that businesses would use. The first would be FOB shipping point, right? Shipping point meaning that the ownership passes on to the buyer from the shipping point, and therefore, if the buyer owns the goods from the shipping point, it means that the buyer is responsible for the freight or for the shipping cost to bring it to wherever it wants to sell the goods, right? And on the other hand, if it is FOB destination, the ownership only passes on to the buyer as at the destination, meaning that the seller is actually in charge of paying for the shipping cost, bringing the goods from the warehouse to the buyer's storefront. Okay, so FOB shipping point once again tells you that the buyer pays for the shipping cost, whereas for FOB destination, the seller is going to pay for the shipping cost. Okay, so just recall these two terms, and so you would know if you're the buyer or the seller, should you be recording the shipping cost based on what are the shipping terms. Okay, so after we purchase the products, right, I also taught you a few methods to do inventory costing, right? So when we have inventory, we have purchases, we have sales, and how do we record the value of our inventory at the end of each period? Okay, I introduced to you this format to track the inventory, and you guys also practiced it in class as well as through your assignments. Okay, so when we have purchase of inventory, right, we would record that in these three columns. When we have sales of inventory, we would record them in the next three columns. And finally, we would have the balance updated after each purchase or sale. So in this example, right, on 5th of January, we purchased 2 units at $1,000 each, right? And so the balance would be 2 units. Unit cost would be $1,000, right? Total is $2,000. On 5th of February, okay, we purchased 3 units for $1,200 each. Total, we spent $3,600, okay? And the total balance of units would be 2 plus 3 equals to 5, right? And the total cost would be $5,600 divided by 5, which would be 1120. Okay, so in this example, we are using the average cost method. So we can simply take the total cost of the inventory to date divided by the total units we have on hand to arrive at the simple average of 1120. Now, on the 1st of March, we then sold 1 unit. The unit cost would be 1120 as taken from the balance in the previous row, right? And so we would have remaining 4 units left over after selling 1 unit. Unit cost remains unchanged because there were no new purchases, and total inventory balance to be recorded on our balance sheet would be 4480. Okay, this is the simple kind of average cost method. Now, I also introduced to you guys the first in, first out method, or the FIFO method. Okay, this would mean that whatever inventory we bought first, okay, we would use that cost in recording the sales, right? So the kind of the top would be the same on the 5th of January, right? What is different is on the 5th of February, after we purchase 3 units, we are going to split out the balance as such. We are going to have 2 units at $1,000, 3 units at $1,200. This tells us that any sale should be first taken from the $1,000 before we move on to the $1,200. Okay. 1st of March, right, we sold 1 unit, and we know that first in, first out, the first unit that we bought cost $1,000, and so our unit cost would be $1,000. Okay, and the balance would be out of the 2 units at $1,000, we sold one of it, meaning that we have one left, and so the balance is 1 unit at $1,000, and the remaining 3 units at $1,200. Okay, so first in, first out kind of requires us to list how many units at the cost price, how many units at the cost price, so that when we do sales, right, we know which chronology to follow, right? It's always the first one that entered first. We would use that cost when we are doing sales. That is first in, first out. Okay, so after inventory, we also moved on to kind of accounts receivable. And when we were introducing the accounts receivable accounting, right, I also talked about the concept of uncollectible accounts. Okay, so in this example, world famous toy company begins its business on 1st of January 2021, and on 31st of January, the total AR was $250,000. Okay, as of this date, right, the credit manager, based on his past experiences, reviews the AR and says that about $10,000 of these accounts would be uncollectible eventually. Okay, so don't worry about how to calculate this $10,000. If I were to test you in the exam about uncollectibles, I would directly give you the $10,000 without asking you to compute it, right? But of course, in class, I did kind of go through in businesses how they actually compute the $10,000, which is to assign a percentage of uncollectibleness to each of the aging of AR, meaning that if it is not overdue, maybe only 1% would be uncollectible. If it is 30 days overdue, maybe 5% would be uncollectible. Okay, so that's how they do it kind of in practical sense. But for the purpose of your exam, you just have to know how to write the journal entries. Okay, so what is the adjusting entry to be made on 31st of December, right? First up, we would have the uncollectible accounts expense, right? And for expenses, we are going to debit it. And for credit, we would credit the allowance for doubtful accounts, right? Allowance for doubtful accounts is a contra asset account, meaning that it reduces the value of our assets, right? So the main asset account that it is tied to would be AR, okay? And allowance for doubtful accounts is going to reduce the value of AR such that the net AR total value would be reduced by $10,000. Okay, so once again, I'm going to debit uncollectible accounts expense, credit allowance for doubtful accounts. Now, how about for notes receivable, right? Recall I said that if a company has accounts receivable, right, with its customer, and later on the customer is unable to pay up, right, it is common business practice to then convert this AR to notes receivable. Okay, what is the difference between AR and notes receivable? The main difference is the collection of interest. For AR, we pay the net value probably within 30 days, and we do not ask for any interest for that 30 days. However, if it is overdue, right, more than 30 days, then it could be converted into notes receivable, where the seller would start to charge interest for its for it being overdue. Okay, so for example, right, on the 1st of December, a 3-month 6% note receivable is acquired from a customer to settle the existing AR of $60,000. So in this case, the customer owes the company $60,000, and he kind of needs 3 more months to repay it, and in return, he agrees to pay 6% of interest. Okay, how do we account for something like that, right? The appropriate journal entry when you first convert AR to notes receivable would be, of course, to reverse the AR, right? So AR usually has a debit balance because it is an asset account. So debit balance, if I want to reverse or make it zero, right, I'm going to credit AR 60K. At the same time, I'm going to create another asset called notes receivable. So debit notes receivable 60K. This first journal entry is to simply move the balance from AR to my notes receivable account. Okay. Now, 1 month later, the company wants to do its closing books, right? So therefore, it needs an adjusting entry. And on 31st of December, how do we compute the interest earned on this particular note, right? We would take the principal amount, $60,000, multiplied by the annual interest rate, 6%, then multiplied by 1 out of 12 months to show that we are accruing for just 1 month of interest. Okay, that would be $300. So in this case, I would debit interest receivable $300 and credit interest revenue $300. Typically for notes receivable, right, the interest would only be paid together upon expiry of the note, meaning that if it is a 3-month note, the company would only receive 3 months worth of interest upon repayment of the full 60K principal amount. And so in the interim, right, they have to record a interest receivable account to kind of tell themselves that, hey, you have to collect this interest in 3 months' time. Okay, so that's for notes receivable. Okay, so this is kind of going further into depreciation, right? In the earlier part of this class, when I showed you the depreciation adjusting entry example, right, that was just kind of a simple average cost of how we can calculate depreciation. And so now in this slide, I would then go into further details on what are the different methods to calculate depreciation expense, right? And that is based on this example that we've gone through in class. So in this example, right, the firm bought a new delivery truck for $17,000 at the beginning of the year, right? And it has a residual value estimate of $2,000. So residual value would mean at the end of the useful life, when the firm is done using the truck, they estimate that they can sell the truck for $2,000, or they can, scrape it, and the scrap metal would be worth $2,000. Okay. They also further estimate that the truck would have a useful life of 5 years. Right? So now we're going to assume that the firm adjusts for depreciation expenses annually as at the year end. And under different depreciation methods, how can we actually calculate the annual depreciation expenses? Okay, the first method that kind of we introduced in class would be the straight line method. Okay, so straight line method actually would just be the simple average, but of course the key is you have to minus off the residual value. Okay, so do remember this formula over here for straight line method. We first have to take the cost of the asset minus off its residual value at the end of useful life, divided by the years of useful life that we are planning to use the truck for. So in this example, it would be $17,000 minus $2,000 of residual value divided by 5 years of useful life, meaning that our annual depreciation for the truck would be $3,000. Right, and in this depreciation schedule, right, we can see how it is computed. Okay, we simply take 15K, which is 17 minus 2K, multiplied by 1/5, because we intend to use it for 5 years. That would give us $3,000. Okay, so every year for under straight line method, depreciation expense should remain constant at $3,000. Okay, and in the first year, right, we would have accumulated depreciation for that year, $3,000. That would then reduce our net book value by $3,000, right? So first we start off with 17K minus of 3K, that would be $14,000, right? In the second year, accumulated depreciation would be depreciation expense for that year, 3K, plus accumulated depreciation from the previous year, 3K. So in the second year, total accumulated depreciation would be 6K, right? And then we further reduce the book value by $3,000. Okay, so the key for this schedule is that at the end of the 5th year, my net book value should be the same as my residual value. Okay, so it's $2,000 over here, which shows that after I take off my residual value, I allocated the cost of 15K over the course of 5 years, bringing my net book value of my truck to $2,000. Okay, so this is for the straight line method, and I guess this would be pretty straightforward to calculate. Now, the second method of depreciation that we covered in class would be what we call the declining balance method, right? And for the purpose of this module and for the purpose of your exams, when I talk about declining balance method, it would always be double declining balance, which is 2 times, right? Of course, in practice, declining balance could be different multiples like 2, 3, 4, or 5, but for the purpose of our class, it would always be double declining balance, which is 2 times the specified rate. Okay, so how do we calculate sort of depreciation expense under declining balance method, right? For the formula, it would be the remaining book value as at the end of each period, right, multiplied by the accelerated depreciation rate. Okay, how do we calculate the accelerated depreciation rate? We are going to take the specified rate, and in our case, it is going to be 2, right, multiplied by 1 over useful life. Okay, which means that because in the purpose of our class, it is always 2, right? So the specified kind of the accelerated depreciation rate would always be 2 over useful life. Right, now let us look at the example. Okay, so same kind of numbers as before. The truck cost $17,000, 5 years of useful life, $2,000 of residual value. Now, under the declining balance method, we do not deduct the $2,000 residual value when calculating depreciation expense at the start. Okay, we simply take the direct book value. So book value when we first purchased the truck would be $17,000. Okay, first year of depreciation would be 17K multiplied by 40%. Okay, how did I get 40%? Okay, recall under the normal straight line depreciation method, because we divide it by 5 years, the normal rate would be 1/5. Okay, and under double declining, we are going to take 2 times 1/5, which is 2/5, which is then 40%. Okay, so that is the depreciation rate under double declining balance method. So in the first year, I am taking 40% multiplied by 17K. Depreciation expense is 6.8K. Accumulated depreciation is also 6.8K. And for book value, I am taking the ending book value from the previous row minus accumulated depreciation equals to 10.2K. Okay, now to calculate the depreciation expense for the second year, I'm going to take 10.2K multiplied by 40% once again, arriving at my depreciation expense of $4,080, right? Accumulated depreciation is 6.8K plus 4080 equals to 10,880. Okay, so book value would be 17K minus 10,880, giving me 6120. Now I'm going to repeat the same thing for the third and fourth year, and only in the fifth year, my computation is going to differ slightly, right? So in the fifth year, this is where the consideration of residual value come into play, right? I know that my ending book value cannot go below $2,000 of residual value, so my depreciation expense for the fifth year would simply be the starting book value, 2203, minus my residual value that I cannot go below, which is 2K, right? So my depreciation expense is only 203. All right, this would help my ending book value to be $2,000, which is also the residual value, right? So let me repeat that. Because I know that my ending book value cannot go below my residual value of $2,000, so the depreciation expense in the final year under declining balance would be just the ending book value from the previous year minus residual value equals to my depreciation expense. Okay, so this is how we would calculate our depreciation expense under the double declining balance method. Okay, finally, we would have what we call the units of output depreciation method, right? For this, it is basically how many units I'm going to use, right? Then how many units I'm going to depreciate it by. Okay, the general kind of idea is that I would record more depreciation when the item is being more heavily used. Okay, so in this example, right, we bought a $35,000 truck with an estimated salvage value of $5,000. Okay, and we estimate that we're going to drive the truck for a total of 60,000 miles. Okay, so how do we look at the formula for units of production? First, we would take the cost of the truck minus the residual value divided by total units of output. Okay, so in this example, that would be $35,000 minus $5,000 of salvage value divided by 60,000 miles in total. That would be 50 cents of depreciation expense per mile driven. Okay, so say for example, in that year, the question tells you that the truck was being driven for 17,000 miles, right? To calculate the annual depreciation expense, you would simply take 17,000 miles multiplied by 50 cents per mile, which would give you $8,500 annual depreciation for that particular year. Okay, so this would be units of output depreciation method. Now, we next move on to kind of accounts payable, right? And in accounts payable, part of financing, right? We also introduce the concept of note amortization, where a note amortization is simply the flip side of notes receivable, right? So on the one hand, you have notes receivable from the company, from its customers, and on the other hand, on the person who owes or on the customer's account, right, you would have a note payable. Okay, so in this example, right, on 1st of January 2026, ABC issued a 15-year, $720,000 note payable where they borrowed from XYZ Bank. Okay, so some parameters given, the note carries an annual interest of 10%, right, and is fully paid over 180 months, right? So 12 times 15 years would be 180 months with monthly installments of $8,000. So the accountant prepared the following amortization table that is partially shown below, right? And this is kind of the format that we introduced in class, which I find helpful to learn for your final exam. Okay, so on the issue date, right, of course, we do not pay anything yet. So the unpaid balance would be the total principal of $720,000. Now, in the next period, right, because this is monthly installment, the next period would be the following month, 1st of February 2026. And the question says that the monthly payment is $8,000. Okay, how we calculate the interest expense would be following this formula, where we take the monthly interest rate multiplied by the previous unpaid balance, right? So interest rate is always quoted per annum basis, that is 10%. We are going to divide it by 12 because we need the monthly interest rate multiplied by the previous unpaid balance of 720K. So interest expense for the first period would be $6,000. Okay. Next up would be the principal reduction, and we can simply follow the formula in blue over here, where it is the monthly payment of 8K minus of the interest expense of 6K, which means that we reduced our principal by $2,000. Okay, how do we think about principal reduction? It simply means that out of the $8,000 that we paid, $6,000 goes towards interest expense and $2,000 reduces the value of the loan that we took out, right? So it means that for the unpaid balance, we are going to take $720,000 minus of principal reduction of $2,000 equals to $718,000 of unpaid balance. Now, interest period for the following month would be on 1st of March. Monthly payment remains the same. Interest expense would now be 10% divided by 12 months times 718,000, right, from the previous row. That would be interest expense of 5,983. Principal reduction would be 8K minus 5,983 equals to 2,017. Okay, and the unpaid balance, of course, would be 718,000 minus 2,017 equals to 715,983. Okay, so generally for note amortization, as long as you understand the logic of how each column is being derived, then you should be able to produce an amortization schedule as such if you are given different parameters. Okay, so that's for note payable or note amortization. Now, that is kind of what we went through for financial accounting. And if you recall, after we talked about financial accounting, we then moved on to managerial accounting, right? And specifically for your group case assignment, we also kind of went into more details about what managerial accounting decisions can look like and how it can affect the firm. And I gave you two kind of real life case examples in Tesla and in BYD. Right? So how do we first think about the differences between financial accounting and management accounting, right? There was a slide like that I introduced in class, okay, which I will now go through. So the purpose of financial accounting, right, would be to provide information about the financial position and performance of the company. So financial position, we can see from the balance sheet, as at the balance sheet date, how much cash do we have, how much AR do we have, what is our total retained earnings, okay? And financial performance more or less pertains to the performance for a particular period, right? So this is typically seen from the income statement, meaning from 1st of January 2025 to 31st of December 2025, what is the net income that we earned, right? What is the total revenue, total expenses, so on and so forth. On the other hand, for management accounting, right, the purpose is really to provide internal information to the management because they want to plan and budget for the next year. Okay, so they're going to look backwards from 1st of Jan to 31st of December, right? How did the individual units or the individual departments actually performed, right? So they want to evaluate and reward those departments with good performance, right? And they also want to plan for 2026, right? To forecast their sales and to adjust their business strategies, so on and so forth. Okay, now in terms of the types of reports for financial accounting, the main output would be balance sheet, income statement, and statement of cash flows, which I guess you guys have seen when I asked you to look at the annual reports of Tesla and BYD, right? So those are typical types of reports under FA. However, for management accounting, there is no standardized format across firms. In fact, each firm would choose the format that is most useful for their own decision making, and they would produce reports accordingly. Right, so under FA, we typically follow IFRS for the majority of the world, and of course, in the US, they follow the US GAAP. Right, under management accounting, there is no standardized way to produce the reports, and that is because there are no commonly accepted standards under management accounting. Okay, so for the reporting entity, FA would be usually viewed as a whole company, right? And then we would present the annual report. Whereas under MA, it can be broken down into product lines, geographical areas, divisions, departments, whatever units that the management think is most suitable to evaluate performance. Now, for the time period, right, FA is typically going to be a year, a quarter, or a month, depending on what are the needs of the external stakeholders, right? Typically, for publicly listed firms, we expect them to report quarterly financial statements, right? Whereas for MA, it can be as minute as weekly, right? If I want to monitor kind of the performance of my supply chain, I might require weekly reports to keep updated on how my supply chain efficiency is moving along, or it could be the entire year where I want to see how my sales is doing as compared to sales forecasts. Now, finally, for the users of FA, that would be investors, creditors, and typically parties external to the firm who want to evaluate the firm performance. Whereas for the users of MA, it is typically top management, customers, and others in the value chain, your suppliers, your customers, people who have a vested interest in how your firm is being run internally. Okay, so this is kind of a broad overview of the purpose of FA versus MA in accounting. Okay, so in our MA sessions, right, I also introduced this graphic where we kind of try to summarize what are the different costs that a manufacturing company could face. Okay, so for a manufacturing company, they are going to produce goods in-house, right? And so on the kind of FA side of things, where we only see the total cost in operation, right? In actual fact, it is broken down into a lot of different components, which in our MA sessions we tried to go through. Right. So in terms of operation costs, we would have first up the product cost or the manufacturing costs. All these directly pertain to producing the goods and that the company wants to sell. Right. The second kind of cost would be what we call the period cost, or more or less the fixed costs, which is those costs that cannot be directly attributed to a specific product. Right. Furthermore, for product costs, there could be direct material, right? So for example, we manufacture a bicycle, so the direct rubber, the direct metal steel bars that we buy, those direct materials that goes into manufacturing the product would be direct material cost, right? Direct labor would be the labor used for the assembly men to assemble the pieces together. And finally, we have manufacturing overhead, right? Typically, manufacturing companies would have kind of factories, right? So electricity to run the machines, security guards to man the factory. These would be considered manufacturing overhead. Right? Of course, for manufacturing overhead, we would then further classify them into indirect materials, indirect labor, and other manufacturing overhead. So let's kind of go into more details on each of the different product cost components. Okay, the first would be direct materials, as these are the raw materials and component parts that become an integral part of the finished products, and they can be directly traced to the products manufactured. Right. So in the class example, right, I talked about Conquest Inc., where they produce mountain bikes. Okay, so some of the direct material examples included would be the tubes for the bicycle frames, the brakes, the pedals, the tires, so on and so forth. Whenever we try to track the cost flow, right, we would do the following. When we purchase materials, we are going to debit materials inventory, credit cash, right? So if you see the T account of the materials inventory over here, we have purchase of direct materials, debit. Now, when the employees actually use up these materials in production, we are going to transfer the balance from materials inventory to WIP inventory. Okay, so I'm going to credit direct materials from materials inventory and debit WIP inventory to show that it has been used and therefore transferred into WIP inventory. Now, on the kind of balance sheet, of course, we would show the breakdown of inventory. Materials inventory is one line item, WIP inventory is one line item, and finished goods inventory would be another line item. Okay, so in terms of direct labor, right, these are labor that includes those who work directly on the products being manufactured, either by hand or using machines. Right, so back to our conquest example, direct labor would be the wages for the cutters, right? So for example, you buy a very large tube of steel, right? You have to cut it to the correct handlebar size for each bicycle, right? So those cutters, right? The painters of the steel bars, the assemblers, the packers, and the welders, all of these would constitute direct labor. When we pay the workers, right, we are going to debit direct labor, credit cash. And when we are tracking the employees working in production, right, we are going to credit direct labor and debit WIP inventory, right? So as you can see, WIP inventory reflects what is the total cost being incurred when we are working on manufacturing these products and services. And WIP simply means that it is still in progress and it has not been completed. Now, we also talked about job order costing, right? And the kind of the main goal of job order costing is to figure out how much overhead to apply to each job, okay? So the cost of a job would be direct materials, which we went through, plus direct labor, plus manufacturing overhead, okay? So how can we trace manufacturing overhead to each particular job, right? One possibility is to use the overhead application rate times the activity-based units used. Right, the overhead application rate is typically determined at the beginning of the period based on this calculation over here, right? Where overhead application rate is simply the total overhead cost divided by how many units we expect to produce for that activity base. Okay, so in this example, right, CompuLine Core, they develop customized computer software programs for other companies, and we assume that at the beginning of 2021, the management makes the following estimates for the coming year. Okay, so total overhead cost would be $360,000, total direct labor hours would be 30,000, and total line of code that they produce is 1 million lines of code. Okay, so option A, suppose that the company uses direct labor hours as overhead application rate, right? So I'm going to take total overhead cost of $360,000 divided by 30,000 hours of labor. That would give me $12 per labor hour. So if job A uses 100 direct labor hours, I would be taking $12 per hour multiplied by 100 hours equals to $1,200 of overhead cost. Okay. On the other hand, if job B is more kind of labor intensive, it uses 200 direct labor hours. I would take the rate of $12 multiplied by 200 hours equals to $2,400 of overhead manufacturing cost. Now, continuing the same example, in option B, the company could also choose to use the lines of code as an activity base, right? And in this case, I would take the total cost of $360,000 divided by 1 million lines of code. That would give me 36 cents per line of code. Okay, in job A, it produced 1,000 lines of code, which would be calculated as 36 cents per line times 1,000 lines equals to $360. Now for job B, right, we use more lines of code at 3,000 lines of code. So we would use the same application rate of 36 cents multiplied by the output of 3,000 lines of code equals to $1,080 overhead manufacturing costs assigned to job B. Okay, so we can see that for job order costing, right, one possibility is to use the activity base, right, to calculate the application rate, and then take the application rate multiplied by the actual activity used for each job in order to allocate our manufacturing overhead. Now, kind of the last thing that we talked about under kind of manufacturing costs would be activity-based costing, or ABC for short. For this particular allocation overhead method, right, the difference is that we use different overheads for different types of activities. Okay, in the previous job order costing example that I talked about, we simply use line of code for as a simple way to calculate manufacturing overhead for the entire job, right? But in practical sense, right, one job can consist of different activities, and so ABC says that we should use different overhead rates for the different activities per job. Okay, this is because different indirect costs can have different cost drivers, and ABC can better help managers understand what are the different activities driving the overhead costs. Okay, some examples of cost drivers would be supervising direct labor, setting up machinery, or consuming electricity. How do we do ABC, right? We went through this example extensively in class. So the step one would be to subdivide overhead costs into the number of activity pools, where each pool would represent an overhead activity, right? And the second step would be to apply overhead costs in each pool to production separately for the pool. Okay, for the purpose of the final exam, right, I would always give you the total cost per pool. I will not ask you to calculate the overhead cost, right, but that would be directly given to you. So you can simply focus on step 2 in the preparation of your final exam. Okay, so therefore, I'm going to only go through on this slide for step 2 under ABC, right, which is to allocate activity cost pools to the different products. Okay, so something like that could be given to you where I tell you that there are 4 different cost pools involved in this particular job, right? The first, we would have the repair cost pool where I allocated $108,000. Second cost pool would be the setting up cost pool, which is allocated $72,000. Third cost pool would be heating, right? That is $24,360. And final cost pool would be machinery, which is $45,240. Okay, so after the cost for each pool is being allocated, we would then see what are the different cost drivers for the pool and how should we allocate it. Okay, recall in this example, right, we were producing metal cabinets and wooden cabinets. Okay, so in the repair cost pool, we found that 250 total work orders were given to the repair department to ask them to repair the cabinets, right? And of 250 orders, 200 orders pertain to metal cabinets and 50 orders pertain to wooden cabinets, right? If we take 200 divided by 250, that would be 80% of the cost being allocated to metal cabinets, and that is $86,400, right? And the remaining 20% is allocated to wooden cabinets, which is $21,600. For the setting up cost pool, right, we figured out that we needed 200 production runs, of which 150 runs pertain to metal cabinets, 50 production runs pertain to wooden cabinets, right? And then we would allocate the cost accordingly to the percentages. For heating cost pool, right, the total heating space area is 40,000 square feet, of which 34,000 square feet was for storing the metal cabinets, right, or producing the metal cabinets, and only 6,000 square feet was for wooden cabinets, and then we allocate the cost accordingly. Finally, for machine hours, right, we found that the machine had to run 50,000 hours, of which 45,000 hours was used for the purpose of metal cabinets and 5,000 hours was used for the purpose of wooden cabinets. Okay, and finally, how do we allocate it to the different product lines, right? We simply add up anything that pertains to metal cabinets from each cost pool, right? So that is 86.4K over here, 54K, 2706, 40716. I add all of the different costs pertaining to metal cabinets, right? Then I divide by the total metal cabinets that is produced, which is $4.81 per unit. This means that for each metal cabinet that I produce, the manufacturing overhead being allocated to each metal cabinet should be $4.81. All right. Same goes for wooden cabinets. Add up the different costs allocated to the wooden cabinets across the 4 different cost pools. Divide by total 9,000 wooden cabinets that is being produced. That gives me $5.31 per unit. Okay, so all these kind of the past 28 slides that I've described are once again the most important parts that you have to learn really well in preparation for your final exam. But of course, the important caveat is any kind of a slide that I went through in class is part of your exam syllabus and could potentially be tested. But for the purpose of revising for your final exam, I would recommend that you start from this particular deck of slides, right? And after you finish kind of this particular deck of slides, I would then recommend you go through each week's class slides, right? And then go to the practice questions at the end of each week's class slides and try to redo those questions without referring to the slides, right? I recall that in class, right, you could always refer back to the class slides in order to practice those questions. But for the purpose of your revision, I would say refrain from referring to the class slides and see if you can actually complete the questions independently, right? Only after you are sure that you can finish the practice questions individually, then you should do the 2 different mock exams that I've uploaded. One was uploaded during the Chinese New Year period, and the second has been uploaded under today's class. Both practice exams, kind of difficulty level is similar to the final exam, and you should try to do them without referring to the class slides, okay? And that is kind of how you know that you are more or less prepared for your final exam. Okay, I should stop the recording here.